Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Here are two numbers, 12 and 53. 12 is how many months the Federal Reserve has held its rate steady, zero cuts, zero hikes, a flat line for a full year. 53 is how many basis points, and a basis point is just 1/100%, so we're talking a little over half a point. 53 is how many basis points the 30-year fixed mortgage dropped during those same 12 months, from 6.83% last April down to 6.30% on the Freddie Mac print from April 16th. Those two numbers don't square with the story most investors are telling themselves about this market. Hey, Prime investors, Martin Maxwell here. Welcome back to the 5-Minute Prime Podcast. The stakes. We're in the expand phase of the Prime framework today. Scaling, capital allocation, how you decide when to pull the trigger on your next door or your fifth. Tomorrow afternoon, Jerome Powell steps to a microphone at 2:30 Eastern. Every real estate podcast, every mortgage broker LinkedIn post, every YouTube rate update channel is going to lead with what he says. And most of them are going to tell you some version of the same sentence. Here's what it means for your mortgage rate. Here's the thing. The Fed doesn't actually move your mortgage rate. Not directly. Not the way the headlines imply, and I can prove it. Not with an opinion, with 12 months of federal data. Today, we're going to walk through the receipt. Then we're going to talk about what's actually moving your rate, because something is. Then I'm going to give you a challenge for Thursday morning that could save you real money on your next deal. Let's get into it. The 12-month receipt. Pull up two charts. If you're near a keyboard, actually do it. Chart 1, FRED, Series Fed Funds. That's the Federal Reserve's target overnight rate. Zoom out to April of last year. Look at the line. It's flat. For 12 straight months, the Fed has sat at the same target range. No cuts, no hikes, nothing. The line is a runway. Chart 2, FRED, Mortgage 30 US. That's the Freddie Mac 30-year fixed rate published every Thursday, same 12 months. In April 2025, that rate printed at 6.83%. This April 16th, 9 days ago, it printed at 6.30%. That is a 53 basis point drop, more than half a percentage point. And it happened while the Fed did absolutely nothing. Stop right there. If the story were true, if the Fed actually moved your mortgage rate, a 53 basis point drop in a flat Fed year shouldn't be possible. The story says the Fed is the lever. Pull the lever, the rate moves, except the lever didn't move, and the rate dropped anyway. And Wednesday, when Powell announces this week's decision, CME FedWatch has it priced at a 97% probability of a hold. 13 straight months. By Thursday morning, when this episode airs, your mortgage rate will still be sitting around 6.3%. That is not a fluke. That is how the market actually works. What's actually moving your rate? Okay, so if the Fed isn't driving your mortgage rate, what is? Let me give you the structural answer. 45 seconds. Stay with me. Your 30-year fixed mortgage is priced off a bond, specifically a mortgage-backed security, a bond where the underlying asset is a pool of home loans. Every day, pension funds and insurance companies and sovereign wealth funds are trading those bonds. Their pricing decides what rate your lender can offer you, not Powell's statement, not the dot plot, the bond desk. And those mortgage bonds track the 10-year treasury, plus a spread, and by spread I just mean a premium, extra basis points layered on top of the treasury yield. When bond investors think long-term inflation is cooling, they buy 10-year treasuries, yields fall, and mortgage rates fall with them. When they get nervous about inflation, the reverse happens. Here's what that looks like in real time. When a cooler than expected inflation print landed earlier this month, bond traders bought treasuries that afternoon. The 10-year yield dropped. And your mortgage rate, the one you're shopping right now, was 7 basis points lower by the following Thursday. That fast, that direct, no FOMC meeting involved. The Fed funds rate, by comparison, is a completely different animal. That's an overnight rate, what banks charge each other to borrow for one night, different product, different buyers, different time horizon. Your 30-year mortgage does not live in overnight rate land. The two rates sometimes move in the same direction. Right now, they're moving in opposite directions at the same time, which is exactly what that 53 basis point drop in a flat Fed year is telling you. Here's the number I want you to write down. Since 2000, the spread between the Fed funds rate and the 30-year mortgage has averaged about 170 basis points. Today, that spread is closer to 260, 90 basis points wider than historical norm. That's what I'm calling the Powell spread. 260 basis points of daylight between the lever Powell controls and the rate that shows up on your loan estimate. 90 of those basis points move on their own. Bond investors decide it. Powell doesn't touch it. And listen, if you've been waiting on the Fed, I get it. Every major headline says rates drop when the Fed cuts. That's a shorthand, and the shorthand is wrong. It's been wrong for 12 months. But don't feel dumb for believing it. Most professional mortgage traders tell a simpler version of the same story when they're explaining it on cable news because the real explanation takes 45 seconds and the producer gives them 15. So you learned the wrong story. Okay, now you have the right one. What 12 months of data means for your next door. Let me make this concrete because we're in the expand phase and data without math is just trivia. Say you're looking at a typical deal, $300,000 purchase, 25% down, $75,000, $225,000 loan, 30-year fixed. At last April's rate of 6.83%, your monthly principal and interest comes out to $1,471. Call it $1,471. At this April's rate of 6.30%, that same loan is $1,393. Call it $1,393. The delta is $79 a month, $944 a year, a little over $28,000 over the life of the loan. On one property, that's a weekend at the beach. Nice, not life-changing. Now scale it, because we're in expand. 5 properties at the same loan size, 5 times $944. That's $4,719 a year of debt service relief every year for 30 years. That's cash flow you did not have to buy a 6th property to produce, just because bond investors decided the 10-year treasury belonged a little bit lower. That is real money. That already happened. And if you were waiting for the Fed before you acted on it, you missed it. Follow-up question. I know some of you are thinking, should I lock or float right now? My rule, float the rate decisions, lock the deal math. If your numbers work at 6.3%, stop waiting for a lower number. If they don't work at 6.3%, a 25 basis point Fed cut won't save you, because as we just showed, a Fed cut doesn't drop your mortgage rate 25 basis points. Fix the deal or pass on it. Don't hold your breath on Powell. And if he does surprise everyone Wednesday and cut, the rate move I just walked you through already happened. A cut from here is a bonus, not a reset. Back in episode 110, the safety formula, we laid out the stress test framework for this rate environment. 65 to 70% safety LTV, 6-month Fortress Reserve. Go back and run it against today's rate, not the rate you were hoping Powell would deliver. And back in episode 115, we looked at why the Iran war spiked mortgage rates 48 basis points in 5 weeks. Today is the same lesson, quieter version. The mortgage bond market is always moving based on things that have nothing to do with an FOMC calendar. Expand phase investors watch the 10-year yield chart themselves. Here's your challenge for the next 24 hours. Thursday morning, after Powell's announcement, Wednesday afternoon, pull up Fred. That's fred.st.louis.fed.org. Free, no login. Search mortgage 30 US. Write the number down, then compare it to the rate your lender quoted you on your last deal, or the rate your current refi model assumes. If Thursday's number is lower, pick up the phone. Call your lender. Ask one question. Can we reprice or can we extend the lock at today's rate? Most lenders will float you down on an open lock for free or for a quarter point. You'd be surprised how often the conversation just works. Then, and this is the part people skip, re-underwrite. Top 3 deals in your pipeline. New rate, new monthly payment, new DSCR. If they pencil now, stop waiting. Start dialing. No active deal in your pipeline right now, pull the number anyway. Know the rate cold. The next time a listing hits or a scenario lands in your inbox, you'll already know whether the math works. You won't be refreshing Google at the same time you're trying to run a cap rate. The Fed will hold on Wednesday. 97% priced in. Your mortgage rate has been moving the whole time. Powell hasn't. Close the Powell spread for yourself. Don't wait for him to do it. The investors who figured this out 12 months ago are already in escrow. Next episode, Monday. We're going to talk about the tool that answers the question, does this deal still pencil at today's rate, in about 8 seconds flat. Stay with me. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one step at a time.